Hello everyone, and welcome to the Tesla Economist. Right now we're hearing so much about Tesla joining the S&P 500. It's important to try and think rationally outside of all the hyperbole. It can be really easy to get swept off your feet by all the potential we're hearing. Aside from the prestige of Tesla debuting into the S&P, the reason investors are excited is that all the index funds would have to purchase the correct proportion of Tesla shares in order to maintain their S&P fund. Index funds have become very popular, particularly as they charge relatively little compared to mutual funds, and rarely do mutual funds ever even beat the S&P, so it's a great resource for retail investors to place their money without having to know very much about stocks or investing. As a result, some index funds are controlling extreme amounts of money, close to around $5 trillion. Due to Tesla reaching such a high stock price before entering the S&P, it now means that they have reached around 2% of the value of the entire S&P. So to translate, the index funds will need to purchase around $100 billion of Tesla stock in order to have the correct proportions of stocks to match the S&P. Now that $100 billion is at the current price. What happens when they start buying up? Well, we have supply and demand. And when there is more demand than supply, price goes up. As they buy up more shares, there are less shares available in the market, therefore reducing the available liquidity of the stock. On the other hand, the more the price rises, the more investors or traders decide that they think, hey, this is a pretty good profit, I might just lock it in. The question is, how high does it need to get until S&P indexes have weighted all their stocks evenly? So the fact that Tesla's stock price has increased about tenfold over the last year is unfortunate timing for the S&P indexes, but it is what it is, and they will have to pay what it costs. Mark my words, they will overpay for Tesla, and will lose billions as a result. However, next year, Tesla will likely double, so it will work out in the end. But the timing also couldn't be worse for another reason. As in early January, Tesla will announce their delivery numbers. Some investors are expecting them to be not far off the total of the previous 3 quarters of the year, at possibly over 200,000 deliveries. This is obviously a huge deal, and will be a big needle mover for the stock, so the stock price may remain elevated for a little while. As the liquidity eases, I would expect the stock price to drop to a more reasonable level. Now, if we didn't already have the perfect storm for the S&P indexes, Tesla also still has a bit of a short position. Now, when the stock price starts moving north, a lot of short sellers will want to cover their positions to avoid any further losses. To cover a short position, you have to buy stock. So again, that could push the price even further. So, as an investor myself, I'm very interested to see how this pans out. Personally, it won't affect me either way, as I don't plan on selling, although I am sure if the stock price jumps past 2,000, it might put a smile on my face. Yes, 2,000. $2,000 per share. That is what some people are predicting. Sounds insane, but it seems the closest resemblance to what we might see is the infamous Volkswagen short squeeze, when Porsche bought them out. The stock went up 4 to 5 times in days, and then dropped back to the old price. So that could take Tesla north of 2,000 even. Anyway, this is so unprecedented. Having a company of this size enter the S&P so late in the game, no one really knows what's going to happen, aside from a ton of shares that need to be purchased. But you can bet that the rest of Wall Street has their quantitative analysts working around the clock, playing all sorts of scenarios. They will want a piece of this action, I can assure you. So how do you make money on a squeeze? You squeeze harder. The rest of Wall Street could also be buying up massive, further reducing liquidity again, creating an even more insane storm. The quants have assigned certain percentages to what could happen, and then invest accordingly. This is known as asymmetric investing. An example of an asymmetric investment would be if you bet $1, a dice would land on a 6, and if it did, I would win $10. The odds are 1 in 6, so a fair return would be $6, so $10 is asymmetric. Of course, you are still dealing with a 1 in 6 chance, so it's essentially gambling, but imagine if you were allowed to play as many times as you like. Eventually, you would average seeing 1/6 of the time, yet still get 10 times return. So asymmetric investors are continually looking for these overweighted returns. The more you do, the higher chances of them averaging out. Perhaps to help us predict the most likely outcomes, we can look at what's happened in the past to the other companies when they've been added into the S&P. I am of the mind that Tesla is a tech stock, not auto. So I think we can use the following companies as a comparison: Google, Yahoo, Facebook, and Amazon, and see what happened when they were added into the S&P. Besides, there haven't been any new successful auto companies for something like 80 years. Yahoo, added to the S&P in November 1999, so this was around the height of the dot-com bubble. So stock prices were insane and quite possibly not a good indicator of what is happening here. According to Forbes, Yahoo soared 64% in 5 days after the inclusion. Google, added to the S&P March 2006. The stock went from around 180 to 200 in about 10 days, but it was back down mid-180s the following month. The numbers are adjusted for previous splits. Amazon, added November 2005. It was up around 5% over the next few days, but then even lower than before it was added over the following couple of months, so the price didn't hold. Facebook, added December 2013, went from around $55 to $70 and held that price for about 3 months, only to drop back down to $55. To infer from past companies, it's not a guaranteed stock jump. However, Tesla is a much larger company than the others when it's been added. The investors are almost cult-like too. They're not going to sell their shares ever, some of them say. So my thoughts are that there may be a liquidity issue. This could make the stock jump. But once the market recovers its liquidity, then it could simply come back down to where it was previously. But this drop might not be for a while, and delivery numbers may prop it up a bit too. So I hope that sums up for you my view on how I see things playing. However, due to all the hyperbole and excitement of people expecting double-digit increases, it could be a self-fulfilling prophecy. Let me know what you think. I would love to read your comments.